Amazon making history on Tuesday, crossing that $1 trillion market cap milestone.
13 years post-Prime launch, Bezos finally giving us a number that is 100 million Prime subscribers globally.
Who doesn't use Amazon every single day of their lives?
Amazon, one of the largest companies in the world, led by Jeff Bezos, who founded the company in 1994 out of his garage. In the last few years, Amazon has grown to be the largest e-commerce retailer in the world, and its shares have risen over 375% in the last 5 years. Some investors wonder if it's too late to get in, or is it still a good idea to buy? In this video, based on a Morningstar report, we're going to look at Amazon's business strategy, economic moat, risks, uncertainty, stewardship, and profit drivers. Make sure to watch until the end, because if you're a value investor, we're also going to be revealing what analysts think is the fair value of the stock. Now, without further ado, let's get right into this video. But before we begin, if you like this type of content, make sure to smash the like button for the YouTube algorithm and subscribe to our channel. Now, let's talk Amazon stock. Business strategy and outlook. Amazon's disruption of the retail industry is well documented, but it continues to find ways to evolve. Its operational efficiency, network effect, and a brand intangible asset give its marketplaces sustainable competitive advantages that few, if any, traditional retailers can match. The combination of competitive pricing, unparalleled logistics capabilities and speed, and high-level customer service makes Amazon an increasingly vital distribution channel for consumer brands, especially in light of COVID-19 operating restrictions hindering physical retailers. Even with more retailers looking to expand online, we believe Amazon will maintain its consumer proposition through expedited Prime shipping, an expanding digital content library, and new customer services. Aided by more than 540 million estimated global active users, more than 175 million global Prime members, and an unrivaled fulfillment infrastructure, Amazon owns one of the wider economic moats in the consumer sector and is likely to reshape retail, digital media, enterprise software, and other categories for years to come. Key top-line metrics including gross merchandise volume growth, total physical and digital units sold, and third-party units sold continue to outpace global e-commerce trends, suggesting that Amazon is gaining share while fortifying its network effect. On top of its impressive growth, Amazon's COVID-19 related buyer and seller acquisition is helping to build a more visible margin expansion story, despite ongoing investment for Prime one-day shipping, including fulfillment infrastructure and capacity, content deals, Amazon Fresh, hardware such as the Echo and Alexa-enabled products, AWS, and physical store expansion. While some capital decisions haven't always yielded strong returns, analysts are optimistic that Amazon can approach 10% operating margins by 2024 based on Prime member adoption, new subscription services across multiple categories, AWS segment margins around 30%, fulfillment scale, new third-party seller services, expanded advertising offerings, and technology licensing arrangements. Now, Part 2. Economic moat. That was a quick demonstration of how Amazon is able to deliver packages so fast. Now, enough jokes, let's get back to our Amazon analysis, specifically economic moat. The traditional brick-and-mortar retail industry has undergone a period of rapid transformation the past several years, a trend that will likely continue as the industry recovers from COVID-19. With non-existent customer switching costs and intense competition, we've already seen several retailers exit the industry while a host of others struggle to reverse deteriorating fundamentals.
25,000 retail stores to close for good this year.
Market consolidation among mass merchants like Walmart and Costco has played a role in this trend, as have direct-to-consumer investments by key manufacturers. However, analysts view Amazon as the most disruptive force in retail. Its operational efficiency, network effect, and laser focus on customer service provide its marketplaces with sustainable competitive advantages that traditional retailers cannot match. This should yield additional market share gains in the years to come. Despite fulfillment, technology, and content investments, as well as additional expenses for COVID-19, analysts expect Amazon can generate economic returns ahead of their cost of capital assumption over an extended horizon, supporting a wide moat rating. One of Amazon's key advantages is the operational efficiency of its fulfillment and distribution network, which satisfies consumer demand for free and expedited shipping, including expanded one-day delivery options for Prime members starting in 2019. This allows Amazon to generate strong cash flow, which in turn can be reinvested in advertising, customer service, and website enhancements that keep its marketplace robust and customer loyalty strong. In fact, we believe Amazon's brand has come to represent low prices, a wide selection, convenience, and superior customer service, a rare combination among retailers. Amazon also benefits from a network effect, as low prices, an expansive breadth of products, and a user-friendly interface attract millions of customers, which in return attract merchants of all kinds to Amazon.com, including third-party sellers on Amazon's marketplace platform, which represented 53% of total units sold in 2019, and wholesalers and manufacturers selling directly to Amazon. According to research, the percentage of traffic to Amazon derived from search has fallen in recent years at a time when other online retailers have become more dependent on search. This indicates that Amazon is increasingly becoming the starting point for online purchases, akin to a mall anchor tenant. Additionally, customer reviews, product recommendations, and wish lists increase in relevance as more consumers and products are added to the Amazon platform, enhancing its network effect. Analysts like Amazon's ability to compete in digital media, given its sizable customer base, the symbiotic hardware and software ecosystem of its Kindle, Fire TV, Dash, and Echo products, and intriguing advertising and licensing possibilities with Amazon's Echo and other Alexa-enabled voice recognition products. Analysts still view the Kindle suite of products as customer acquisition tools that add multiple layers of upside to our base case assumptions, including additional Prime memberships and engagement levels, accelerating digital media sales, and a positive halo effect on general merchandise sales. Analysts believe Amazon will continue to develop into a formidable player in digital media, given its vast content offerings, inroads into new verticals, including video games, and ability to sell hardware as a loss leader. Analysts believe Amazon Web Services has similarly developed cost advantage, intangible asset, and network effect moat sources. Amazon's public cloud computing offerings possess more than 3 times the computing capacity and use than the next 10 largest providers combined, providing the company with scale advantages and often making it the preferred name for corporations looking to reduce information technology expenditures. Analysts expect AWS to generate $45 billion in revenue during this year, and we forecast average annual revenue growth of 25% over the next 5 years. With recent investments in additional capacity and other innovations, analysts expect AWS to become an increasingly positive gross margin contributor. The segment posted a 26.3% segment operating margin in 2019, and believe it can deliver roughly 30% operating margins over a longer horizon because of its highly scalable nature and other mission-critical services outside of cloud storage, as well as a network of third-party software providers selling on AWS Marketplace. As one of the global leaders in online commerce, Amazon finds itself in a unique position amid the global COVID-19 outbreak. As containment efforts persist and consumers isolate themselves, certain Amazon services will continue to see increased adoption. The most obvious example is online grocery, which has accelerated significantly.
Music and dance.
Free 2-hour grocery delivery. Now with Prime.
Telecommuting, AWS also stands to benefit from increased enterprise cloud computing, storage, networking and content delivery, mobile app, and digital security usage. On top of increased enterprise-level cloud demand, Amazon will benefit from increased demand for entertainment content, either directly, with its own content portfolio or indirectly, through AWS's functionality for Netflix and other content providers. Amazon has done a better job diversifying its product mix toward more consumer staples in recent years, which should help to insulate the company from a global economic slowdown or recession. Now let's talk about risk and uncertainty. Despite its leading position in North American and European e-commerce, Amazon faces several potential risks. Impairment to Amazon's low price positioning, whether real or perceived, could have an adverse impact on fundamentals. Amazon must maintain its value proposition and logistics efficiency to drive marketplace traffic while competing with other merchants for market share. This includes managing Amazon Prime fees, but we believe the combination of fulfillment capabilities, expanded digital content offerings, and new subscription and streaming offerings will keep Prime membership churn to a minimum. Other execution risks include expansion into peripheral business lines and physical stores, including Whole Foods, which could distract management or lead to poor capital allocation decisions. International growth brings regulatory challenges, as foreign governing bodies are constantly amending online commerce laws, often to the benefit of local incumbents. Analysts also expect COVID-related changes in consumer behavior will have a lasting impact on the industry and drive near-term operating volatility. On top of execution risk, there are 3 other sources of potential risk. Number 1, regulatory, including the threat of increased shipping fees from the U.S. Postal Service or other regulated carriers.
You're suspicious that Amazon may have gotten a little too big for its own good, could be vulnerable to government action at some point.
Amazon is harming fair competition here in Europe. That is what the European Commission said today when it filed antitrust charges against Amazon. It accuses the e-commerce giant of attempting to gain an unfair advantage over sellers on its platform.
Higher taxes, restrictions regarding simultaneously operating a first and third-party marketplace, and antitrust or anti-competition investigations. Number 2, direct and indirect competition from other retailers or technology firms.
Time now for the Executive Edge. Walmart is fighting back against Amazon, rolling out free next-day shipping for orders of $35 or more in Phoenix and Las Vegas. The service is coming to Southern California in the next few days, and it will gradually roll out to about 75% of the United States by the end of the year.
Meantime, Walmart announcing its answer to Amazon Prime. It's called Walmart Plus.
And number 3, intangible asset impairment, including data breaches, concerns over inappropriate data usage, or consumer fatigue. On the other hand, we see sources of upside risks from more diversified and specialized AWS offerings, expanded fulfillment by Amazon capabilities, the rollout of Amazon Fresh across additional urban centers, new potential pricing tiers or add-on features for Amazon Prime memberships, new advertising channels, or new technologies like Zoox. Now, on to the next part, which is stewardship. Chairman and CEO Jeff Bezos founded Amazon.com in 1994.
I'm Jeff Bezos.
And what is your claim to fame?
I'm the founder of Amazon.com.
Where did you get an idea for Amazon.com?
Well, 3 years ago, I was in New York City working for a quantitative hedge fund when I came across the startling statistic that web usage was growing at 2,300% a year. So I decided I would try and find a business plan that made sense in the context of that growth. And I picked books as the first best product to sell online.
Analysts view Amazon's management team as exemplary in terms of corporate stewardship. Bezos owns about 15% of the shares, and voting rights for 20%, takes no equity compensation or bonus pay, and collects a paltry salary. Although the board is small, it is elected every year, receives no cash compensation, avoids insider relationships, and hasn't implemented anti-takeover provisions. The company also provides a fair amount of supplementary financial data in its financial reports. Analysts' only complaint is that specific disclosures have not increased as the company has expanded into new areas, including digital downloads, device sales, and Prime membership data, though to its credit, management broke out AWS as a separate business unit in the first quarter of 2015 and disclosed that the company surpassed 150 million Prime memberships globally at the end of 2019. Amazon has made investments to sustain its moat-worthy businesses, including its global fulfillment infrastructure, a vast portfolio of audio and video content, and Amazon Web Services capacity. However, charges tied to the Fire Phone in 2014 and operating losses in certain international markets underscore the importance of Amazon being selective with its capital allocation decisions. Analysts believe the lack of consumer interest in the Fire Phone was a wake-up call for management's capital decisions, as the company runs the risk of losing key personnel without stronger returns on invested capital, owing to the equity component of many employees' compensation structure. However, analysts are comfortable with this risk, based on recent capital discipline and investments that have been more directly aligned with the core commerce marketplace and AWS platforms. Now, the last, and probably the most expected part of the video, fair value and profit drivers. Analysts put their fair value estimate at $3,630 per share, reflecting the time value of money. COVID-19 related changes in consumer behavior are helping to accelerate Amazon's online commerce and related service offerings, partly tempered by near-term COVID-19 related expenses. In Amazon's case, analysts do not believe traditional price/earnings and enterprise value/EBITDA metrics are meaningful, given the impact that near-term investments are expected to have on near-term margins. Still, they believe Amazon warrants a premium valuation based on its wide economic moat, meaningful avenues for growth, and longer-term margin expansion potential. Analysts expect COVID-19 related demand to drive online commerce market share gains in 2020, resulting in revenue growth of around 36%. They also expect average annual revenue growth of 22% over the next 5 years due to greater engagement among Amazon Prime members, increased engagement among third-party sellers, digital content sales, international expansion, and emergent business segments like advertising and technology licensing. With respect to Amazon's sales mix, they forecast online retail revenue to grow 21% annually over the next 5 years, with smaller segments like physical stores, third-party seller services, subscription services, AWS, and advertising growing 4%, 25%, 21%, 25%, and 32%, respectively, over the same period. Analysts forecast a slight decrease in gross margin to 40.8% in 2020, compared with 41.0% in 2019, due to COVID-19 related expenses, but expect gross margins will improve to 42.6% over the next 5 years. Amazon's growing clout with suppliers and advertisers, a higher proportion of third-party units in the sales mix, AWS customer acquisition and greater engagement among existing AWS customers, and advertising service offerings should allow for higher gross margins. They also forecast operating margin expansion through increasing expense leverage, particularly in the marketing and general and administrative expense line items, contribution from AWS, and accelerating third-party unit sales. The analyst model calls for a 5.7% GAAP operating margin in 2020 versus 5.2% last year, but approaching 10% over the next 5 years, based on its strong competitive positions in AWS and North American e-commerce, as well as early indications of success in certain international markets. Well, that's it for today's video. Do you own Amazon stock? Let us know down below in the comments section. These videos take a lot to make, so if you learned something or enjoyed this video, we would really appreciate if you smash the like button and subscribe. Thank you, and stay bullish.